Hello everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmgren, and with me here in the studio is my friend and colleague, Niklas. How are you?
I'm really energized after having vacation in Greece and eager to speak with today's guest.
Sounds great, and I also think it would be really fun to interview Ian Cassel. Ian is the founder of MicroCapClub and is the CIO of Intelligent Fanatics Capital Management. He is the co-author of the Intelligent Fanatics books, which he wrote together with Sean Eddings, and he was actually our first guest here on the podcast. So, which book will we talk about today?
In this episode, we will speak about Golf is Not a Game of Perfect, and this is another example of how it's possible to draw lessons from other areas than investing to become a better investor. I've been a reasonably good golfer myself, and it was with mixed feelings that I read the book, as I wished I would have read it when I was actively playing golf. I realized how many mistakes I made.
I'm not a golfer, but the book is not technical, and I really enjoyed reading it coming from an investor perspective. And I think in so many parts of the book, the word golfing can be exchanged with investing, and the word golfer can be switched to investor. And the author, Rotella, he even uses expressions like risk-reward and margin for error. What do you think about the book otherwise?
I mean, this book is packed with lessons for investors, ranging from having a diligent preparation, to focus on the process and not the outcome, to avoid comparing oneself to others, and also to avoid overanalyzing. And we will discuss much more of that in the conversation with Ian. And there was one quote I absolutely loved about accepting bad shots. Striving for perfection is essential. Demanding perfection of himself on the golf course is deadly. That's a topic that we will absolutely discuss more with Ian.
Golf is Not a Game of Perfect is written by Dr. Bob Rotella and was first published in 1995. Here comes our conversation with Ian Cassel. Hello, Ian, and welcome to Investing by the Books podcast.
Thanks for having me on.
It's great to have you, and thank you for taking the time. So where are you located today?
I am in Lidditz, Pennsylvania, which is in Lancaster County in Pennsylvania.
And to begin, can you tell our listeners about your background and what led you into the world of investing?
Sure. Yeah. And what got me started was when I was a teenager, which to date me, that would have been during the technology bubble, internet bubble, or .com bubble of the late 1990s. And I kind of got my beak wet with investing during that time period. My parents had saved for me a small amount of money that was supposed to be used for college, and I invested that in the markets. And this was like 1996, 97. 5x that in a few years, just because anybody throwing dart at a newspaper of symbols could have done that. And then, got caught the greed bug because I made so much money so quickly, decided to go to a local university, which was less expensive, continuing to invest. I worked for a financial advisor through college and rode down the .com crash, turned that 120,000 USD into about 8,000 USD. A lot of that small cap, mid cap technology companies that I own turned into microcaps. And that's how I got introduced to microcap investing, was coming down the other side of that slope. From there, was just kind of angry, and, I wanted to make this money back, and I was already looking at microcaps in my portfolio. So I started, analyzing them and just kind of started learning the ropes, had a few mentors. Most of the discussion back then in the early 2000s was on public stock message boards. And so that's where you would kind of learn about companies. That's where you meet other people to network and do due diligence. And so I kind of built a reputation on these public stock message boards, kind of learned the ropes of microcap by losing my own money over and over again and making it back. And really with the goal of becoming a full-time private microcap investor. That was my goal since college. And through some luck and some skill, was able to do that in 2009. Right as the global financial crisis was kind of ending, coming out of the bottom. And so, 2011, I launched MicroCapClub.com. Being a full-time private investor at that time, I just wanted to know what other smart people in this niche of micro and small caps, what they liked and why. So created a private forum for doing that. For the first few years, it was just me talking to myself. But then over the course of time, it attracted some really reputable investors, and really 10, 12 years later, it's a pretty cool community of about 240 experienced microcap investors that are global, across the world, really just exchanging ideas and talking about what we liked and why. So that's what microcapclub.com is today. And it still is a valuable tool for my investing. It's really just meant to be an idea generator. What are the best ideas that are out there? Then in 2016, one of the members of MicroCap Club and I teamed up and co-authored on 2 books called The Intelligent Fanatics Project. And the term Intelligent Fanatics is a term that Charlie Munger used in his speeches to basically define a great business builder, a person that built a business from scratch up to a business that dominated its niche geography industry, and not only dominated it for a couple of years, but you're talking about decades, and as an investor investing in small cap and micro cap securities, the smaller the business you're investing in, the more important management becomes. And so I wanted to fine tune kind of my qualitative lens for great leaders, because if you want to find great companies early, you got to find great leaders early. And so really the purpose of kind of teaming up with Sean was just to fine tune that lens for myself. And so we wrote a couple books that, 3 or 4 people read, but we enjoyed writing them. And that's basically how it then pivoted into starting the fund that I started in 2018, which is called Intelligent Fanatics Capital Management. And so we now work with about 70 families, high net worth families that are looking for exposure into kind of intelligent exposure into small and micro cap stocks. And so now we have an asset management business there as well. And so kind of wear a couple hats today. Obviously, still investing is prominent, still kind of leading MicroCapClub and also managing the fund as well on top of that.
Congratulations to all the success. And I mean, both me and Eddie love your books. And I think when we spoke with Will Thorndike previously on the podcast, he also really appreciates the work you have done with these books. And today, of course, we will speak about a book. We will discuss Golf is Not a Game of Perfect. So I have to ask, are you a golfer yourself, or how come you read this book?
I am a golfer, and if you have time, I can tell the backstory of my golf history, if that's interesting.
Yeah, sure. I mean, I share that. I mean, that background as a golfer, and I think we will get into that. I mean, there are so many connections, and sometimes for me it was hard to focus on the lessons from an investor side, because I was a bit annoyed by myself that I didn't read this book when I was a golfer, because I think it would have helped.
No, it is, and it's a great book, and we can get into it in a couple of minutes. I mean, kind of my backstory with the game of golf. I had a friend that was a couple of years older, and he was on the high school golf team. But our high school team was so poor that I was able to make the final varsity slot, for our golf team. And so I ended up playing high school golf. And by my junior year, I was the number 1 player on the team. Not saying that we were a great team. I was decent. I would shoot high 70s. I was not like a scratch golfer or anything like that, but I was consistent. And, that's really how I kind of fell in love with the game of golf. And, I was thinking of a funny story that I don't think I've ever told anybody before, really, but it was our high school golf coach. He was 82 years old, and he was also our high school's baseball coach, ironically. And I remember when I made the golf team, we were having a practice, and we were going to play a round of golf. And he said, "Ian, I'm going to play with you." I said, "Okay, great." And he said, "But I'm going to play one-handed." He's like, "And I bet you I could beat you one-handed against you." And I was just like, okay, there's an 81-year-old man that's going to play one-handed and beat me. And sure enough, I ended up shooting a 92, which was about 10 strokes worse than I normally did. He shoots an 89 playing one with his right arm. and after the round, and I'm so embarrassed. And he came up to me. He came up to me after that. I remember him saying, like, I knew I had you beat. As soon as I said that, I saw your eyes as soon as on the first tee when I said I was going to play one-handed, and you were thinking to yourself, "There's no way I can let this 81-year-old man beat me, one hand." And he did. And he said, "This is a mental game." He's like, I got into your head. You can't let that happen again. If I would have said nothing, you would have beat me 9 out of 10 times, but I got into your head. This is a very mental game. And that was a lesson that was a big impression on me that I remember just reflecting on this podcast we were going to do. That is probably a good lead into the book. And ironically, when I made the golf team my freshman year, that was probably 1996. This book we're going to be talking about, Golf is Not a Game of Perfect, came out in 1995. So that was a year before I got beat by a one-armed 81-year-old man. And I have to give credit to, I believe it was Sidecar Capital, who gave me the book. I didn't read it until 2020, I believe he sent it to me. I tweeted about golf, and he reached out and said, I have a book you need to read, and he sent it to me, and it's been a great read, and to why we're on the podcast today. So all credit to Sidecar Capital for sending it to me.
And the author of the book is Bob Rotella. Can you tell us a bit about him?
Yeah, so I guess Dr. Bob Rotella, he's a sports psychologist. He works with a lot of golfers. I know he's worked with like Davis Love III, Nick Price, Tom Kite. Tom Kite and Nick Price, he talks about a lot in the book because, again, the book was written, I think, in 1995. And those were two, prominent players from the early 90s. But he also has worked with, I think, Padraig Harrington, Jim Furyk, Darren Clark, Rory McIlroy. I think he mentions Pat Bradley. And and Justin Thomas. So he has, I think, worked with, players of today's generation as well. And he really just helps them work on their mental game, and I think probably the first takeaway, one of the interesting things about golf is why I started playing golf. And that's because it can be played over a lifetime. You can really play golf up until, you're in a pine box. And, I think it's one of the interesting things about investing too, is investing is equally fulfilling because you can invest over your lifetime. Investing wouldn't be nearly as fun. I don't think golf would be nearly as fun as if you had to stop at the age of 30 or 40 or 50 or 60, like other sports. You have your entire lifetime. So that in itself, you have to have the patience to become the best golfer and the best investor that you can be. And you can, kind of see your progression over time. So I think that in itself makes an interesting kind of similarity to investing as just golf as a sport. And I think golf is probably the best sport that is comparable to stock picking and active investing in particular.
I mean, one connection there is that in golf, of course, you have to adapt how you play depending on your physical capabilities. And I mean, investing is not a physical sport at all, and not a sport maybe, but you also have to adapt yourself a lot as an investor, I think. I mean, for example, I have many friends who are really, really active as investors, and I mean, they are more traders, but still have a long-term mindset. And I just think, as a parent myself with small children, it's you feel that there are other things in life, and what type of strategy I have as an investor really changes depending on my life in general. And I just feel that some strategies may work for a longer time. What's your view on that? And have you thought about that?
Yeah, I think there's probably a couple rabbit trails, if you want to call them that, kind of in that thought process. I think the first one is, like you said, as you were talking, I was thinking about just how golf, you can have 2 or 10 or 1,000, 145 yard, 150 yard shots into a green, but none of them are going to be the same. Your lie is going to be different. The wind's going to be different. The temperature is going to be different. The altitude's going to be different. You might be hitting out of the rough. You might be hitting out of the fairway. You might be hitting out of the divot. You might be hitting out of the sand. You might be trying to hit underneath a tree or over a tree. There's no 2 lies that are the same, in golf, even if the exact yardage is the same. And there's this great video. I think it was an interview that David Faherty did with Phil Mickelson. And you can find this clip where he talks about just those different lies. And it's like a 2 or 3 minute segment of this video where he talks about, just how he practices Phil Mickelson practices 1,500 shots per club per month at the exact same yardage. And he's just going through all the different iterations of what's going through his head depending on the lie, the altitude, in the morning, the club goes 5 yards less. In the afternoon, late afternoon, it goes 5 yards more. If you choke down an inch, it takes 3 yards off. It's just like these types of nuances. And, I feel like relating that to investing, like there's so much nuance in investing. And I think stock picking is a game of identifying companies through some broad-based pattern recognition, but it kind of has to be loosely defined, because I think the big money is made analyzing those nuances and getting those right, because you can analyze Lowe's against Home Depot, against Ace Hardware, and they all look the same, but they're very, very different, and I think you find it doesn't matter how you invest, you kind of see it in your own life. There's so many times because of the pattern recognition and a past win that you had in the portfolio, you eventually see something else and you see that same pattern and it reminds you of a past win that you had and you gravitate to that. And that can be good or bad, that can make you irrationally like something too much because it just reminds you of something else that happened in the past that really was probably completely different than what you're looking at. Let's just be honest. And so, I think it's important just to stay rational and realize that each company is different, even if they're in the same industry doing the same thing, and a past win that looked the same isn't nearly or probably not at all the same as a future one that you think has all the same ingredients. So anyway, I don't know if that's one part of what kind of got triggered as you were talking.
And a connection to that is, as you said, you need to adapt to the situation you have. And Rotella presents the need for golfers to have a certain routine before striking a ball. And in investing, we hear about investors going through like pre-mortems and to have checklists for our decisions. And I'm curious to know, how do you think about the balance of staying rigid versus flexible when making an investment decision?
It depends how you invest, but I do think like you have this broad set of principles. That's what I kind of say is this like broad pattern recognition or framework that you have developed over time. And the nuance of it is you have to know where you can bend, on some of those things. And that just takes time and experience and decades to be able to kind of know that. And even when you think you know it, you're going to be wrong half the time. Getting back to kind of the pre-shot routine that you mentioned, he mentions in that book just the importance of the pre-shot routine and how basically a lot of the professional golfers he talks to, like 80% of the golf shot is like in that pre-shot routine and setting up to that shot consistently every time, clearing your mind, just thinking about target and swing. And that consistency of that pre-shot routine puts them in the right framework and mental position to be able to execute on that shot consistently. And I think a consistent kind of pre-shot routine in golf is equivalent to a consistent due diligence process. Whether it's the process, the checklist, the framework, the investment principles you apply to new ideas or existing positions, it's that consistency that allows you to kind of benchmark new ideas against what you already own or new ideas against other new ideas. And, I think that consistent research process and diligence and order ranking ideas is really important, over time, especially as you continue to compound your knowledge and look at more and more ideas. And that will become your greatest asset as an investor is being able to archive that knowledge that you've built over decades in a consistent way and benchmarking those things accordingly. And so I kind of think of the pre-shot routine in golf similar to just a consistent due diligence process.
Rotella writes in the book that you're going to have to learn to think consistently if you want to score consistently.
Yeah.
Brings home the point, I think.
Yeah.
And he also, regarding the routine, he also writes that acceptance is the last step in a sound routine, and that no matter how good you get at this game, a lot of funky, crazy things are going to happen on the golf course. And we talked about the wind and all the things that can happen, and to me that really sounds like the financial markets as well. And you really need to accept what is going on. Do you have like a conscious way of accepting whatever happens, or how do you deal with that?
It's now kind of like relating it back to golf. I think a big chunk of the book is just, it's the title. Golf is not a game of perfect. and I would probably write an article. You could just replace golf with investing. Investing is not a game of perfect. And a big part of golf is just not getting too emotionally high or low, and not getting too low after you hit a bad shot and forgetting that shot, and just playing every shot as they come and not thinking about what you just did. There's this great story in the book that he talks about Tom Kite and himself playing with two, I believe it was Texas collegiate golfers. It's probably the story that is probably the most representative of the book. And he talks about how him and Tom Kite were playing with these two University of Texas golfers. I think they were the number 3 or number 4 in their golf team. And they played their round of golf, and I think they all shot within a stroke or two of one another. And after the round, one of the golfers approached Tom and said, Tom, we basically hit the ball as good as you did today. When we missed a bunker shot, we got it up and down, just like you did. We missed a green, we got it up and down, just like you did. Why are you the leading money winner on in PGA Tour history? We're the number 3 and 4 players on our Texas golf team. And Tom had this great response, and it was basically, the difference is when you guys get into tournaments, the likelihood is that you'll lose your concentration on 4 or 5 shots every round. Over a 4-day tournament, that costs you 16 to 20 shots. And that's the difference between winning a tournament and losing your tour card. And if you let one of those bad shots compound into another bad shot or another double bogey in the next hole, you're not going to make the collegiate golf team. And I just thought that was just an awesome kind of illustration of just how golf is not a game of perfect. It's how you deal with the bad shots. Being a little bit better makes a big difference. And so golf is just like investing. And, it's not about being perfect, not letting your mistakes compound. For me and how I apply with investing, it's working hard to identify the losers in my portfolio as well. And we're trying to identify my losers quicker. Because over a lifetime, and I've tweeted about this, and I mean, it's just, if you're a stock picker that wants to buy and hold great companies, it's like you're probably going to have 10 or 20 big winners over a 30 or 40 year career that make up 90% of your gains. And then you're going to have hundreds of other stocks that you owned over that time period that just didn't live up to your expectations. And so those losers, those hundreds of stocks, are stealing time. They're a waste of your time. And so identifying the losers, I think, is important so you can replace them, with the winners over time. Maybe another lesson, kind of what you leading into this, because I think it's a big chunk of the book, is just learning to accept the bad shots. And he had this great quote in the book. And I think it was something like the professional golfers learn to accept their bad shots, but the amateur golfers don't. The professional golfers can really accept their bad shots a lot better than an amateur golfer can. And maybe that's because amateur golfers have a lot more bad shots than the pro golfers do. But they do a much better job with it. And he talks about, like, with all of the professional golfers that Dr. Rotella worked with, which has been, 50, 60, maybe more than that, professional golfers that I think have won several hundred tournaments, combined, that have won majors. He can remember a handful of times out of those, 100 golfers that he's worked with have won hundreds of tournaments where a golfer said that they played to the best of their abilities for 2 out of 4 rounds, which means they are winning ugly. They're not going out and playing perfect golf when they win a golf tournament. They're learning how to win ugly. And that means accepting bad shots. And that means not letting your bad shots compound into more and more bad shots, more and more bad holes. Because just like golf, investing, golf is he also mentions, going through a few of these things because they all kind of interconnect, but he talks about how a lot of the issues that pros have is they let the start of their round dictate their attitude and their effort. So if they start off with a few bad holes, that discourages them so much. And if you play golf, you know exactly what I'm talking about. You start off, double bogey, bogey. You're just like, why do I even want to play anymore? Let's go to the 19th hole, grab a beer. And it's the same thing with pros. If they start off with a bad 2 or 3 or 4 strokes, it really hits them mentally. And he had this great line where, if you're a victim of the first few holes, you don't have a prayer. He said you're basically like a puppet. You're letting those first few holes jerk your strings and tell you how you're going to feel the rest of the round, and you can't let that happen. And I think relating that back to investing too, it's like we're all going to have bad seasons in investing. You're going to have bad months, you're going to have bad quarters, you're going to have bad years, and you can't let that kind of distract you from the long-term game that you're playing. So anyway, that was a mouthful, but a few of those topics kind of interact, that he talks about, and a lot of the book is about, how golf is not a game of perfect.
From my golfing, I can really say when you shoot one bad shot, you try to make up for it and maybe take up the driver when you shouldn't, and so on. And I was just thinking about your early days as an investor when you went from $120,000 to $8,000, and you said that, you need to make up for it more or less, and it's quite common among investors that we try to get back what we lose. And in terms of how you have gained experience after that. How have you learned to cope with that?
That's a good question. I think, and he even talks about what you just described in his book too, where, the tendency is when you make a bad shot to get more aggressive and bold with the next one to make up for it. And you see that investing too, where if you lose money quickly, you don't stick to the game plan. You look at riskier ways to get that money back quicker. And 9 times out of 10 or 99 times out of 100, that's the wrong thing. You should be playing more conservative. I think Stanley Druckenmiller, who was a trader, he would say you should be, hitting for singles. You shouldn't be hitting for home runs if you're not confident. If you're not seeing the ball, you should just be hitting for singles. And that's how I've tried to be as well. My early years, it was kind of difficult because there was so much luck involved in the first couple of wins. I was just lucky that I invested during the dot-com bubble and made that money and then lost it. And even my first big win in microcap, which was XM Satellite Radio, it's a story I've told before, but it's actually my first time I went and met with a management team, took that $8,000 and bought that stock, and it went up like 14x in 30. What was it? Yeah, 14x in 14 months, something like that.
And you held it.
Yeah, and I held it for I think 10 of those X's, not the full 14. But again, like those were both 110% luck, and I'm self-aware about that. But it doesn't really, a lot of times it doesn't really matter. I know when you guys think about your own investing career, oftentimes it's the first couple big wins that influence where you sit on the risk reward spectrum. So if like the x-axis is a not zero, but a neutral risk tolerance, I got a big win. And so I was always above more of aggressive risk. Yes, I lost a big amount when it came back down, but I had already made money being risky before. So I knew it could be done. So I was still above, that neutral risk tolerance. And then I made it again in XM. So I almost think like those first 2 or 3 wins that you have or losses greatly influence how you see risk, for a long, long period of time. And, I've always been a concentrated investor too, being in 3 or 4 companies. Now it's maybe like 6, but everybody would say that's still insanely concentrated. And it's just because that's where I started and that's how I made money. I've just had comfort in that area. It doesn't mean the way I do it is right for you or anybody else. It's just that's kind of where just my experiences aligned with some of the wins I had. And I think the way you start investing greatly influences where you end up. Like if I would have lost a lot of money the first time out of the gate, I don't know what I would be doing. I would just be in money market accounts or something. I have no idea, and that's happened that way too, right? Where people just lose money the first couple of times. They want nothing to do with the stock market, or they just go into, being a passive investor the rest of their life instead of an active one. And so I think I'm very self-aware about, especially the older I get, the way I do things is the way I do things. It shouldn't be the way that you do things. Because I think your experiences and your wins and your losses really greatly impact your ultimate strategy, and the art form of your strategy is really a fingerprint to yourself, not to anybody else.
I love the Buffett quote that you don't have to make up for your losses in the same stocks that you lost money in the first time, and I see that in many early investors I mean, if a stock is down 99%, they say that this could 100x. And often my experience is that, I mean, you should move on to other ideas, because it's most often it will go to zero.
Well, and to your point, Niklas, before is, you are evolving as an investor. The way I started was in story stocks, and then I kind of evolved into resource stocks. And then I only really kind of what I would say characterize myself into GARP, growth at a reasonable price, kind of focused on profitability. Probably not until 2007. So that would have been well on my way to becoming a full-time private investor, and then I kind of focused on some healthcare. And so when you look back at your journey, it's interesting how you get there. And, the way I invest today isn't the same way I invested 6 years ago, and especially not 12 years ago or 18 years ago. You're going to evolve. And if you're not evolving, you're not growing. It doesn't mean that you have to all of a sudden going from a deep value to investing in Bitcoin. It just means that a lot of the ways you get better are little tweaks, on the edges of your strategy, and that's where the alpha can be had, is just tweaking things here and there.
And one of the golfers in the book, Jim Flick, who's quoted there, he said that a golf player has to pass through 3 stages. And the first one is unconsciously incompetent. And then you get consciously competent. And then you are unconsciously competent. So I think that's quite interesting in terms of what you're saying now, that you have evolved during these steps. And in the book, he also speaks a lot about confidence. Golfers need to think about putting the ball in the hole and be sure about that, not think about the lake, because then the ball is going to go into the lake. How has that evolved in your journey, so to say, with the swings?
I think confidence is really important. I remember you mentioned Flick, and I remember another story in the book. I think it was Rotella was telling a story about, I think it was a story that Davis Love Jr. told. Not Davis Love III, for those golfers that are listening. Davis Love III he's probably 55 now. This would have been Davis Love III's father, hence the junior. But he was also a touring pro. And Rotella was telling a story about Davis Love Jr. sharing a motel room with Gary Player, I believe, for a week. And they were playing several rounds. And he said one day they were playing like shaggy, slow Bermuda grass greens. And Player remarked that he loves playing Bermuda greens, loves playing them every time. And the next day they went out and played fast bent grass greens. And Player remarked, "God, I love playing these fast greens. They're great." And Davis Love's finally just had enough. He's like, "Well, which is it? Do you like playing slow greens or you like playing fast greens?" And Player replied, "You just have to love playing whatever you're on," or something like that. It was a great comment. And it's so true, as investors, as stock pickers, we're sometimes investing in bull markets and we're sometimes investing in bear markets. And, we just can't let the market direction or our portfolio's direction determine our attitude and effort, or how we treat people, for that matter. We always need to stay positive, and I think that's a really important lesson, is just like continuously to be positive and continuing to have self-confidence. You have, when you're doing the work and and the key to this game is doing independent research and forming independent conviction, so you can take advantage of this business when the price is volatile, sitting on top of it, and you know what to do and when. There was another one, I don't know if you guys remember him talking about, but I kind of loved it. The framing that he did was, there's no hot streaks in golf. And I think it was something like, the quote that he had was, the hot streak represents the golfer's true ability. It results essentially from trust. The golfer trusts his abilities. He steps up to the ball knowing that he can pick a target and hit it there. He does things unconsciously. The swing repeats itself. The swing feels effortless. And, I think investing is similar to golf, where, self-belief and self-confidence and conviction are important. They need to be anchored in reality, obviously. They can't be anchored in hope or prayer. But you need to be able to trust your work. You need to have confidence. You need to believe you can hit great shots in golf. You need to be able to believe you can pick a great stock in investing. and if you did the work, you earned it, and I think there's been a few times, I'm sure you guys have had it too, where you had, 2 or 3 big wins in a row. And it's almost like those 1 or 2 rounds, Niklas, that you play a year, where everything clicks, where it feels effortless. And you think to yourself, wow, I really played over my head. Boy, if I could just play like that all the time. And the way Dr. Rotella frames it is like, no, that is your potential. That is what you should be doing and can be doing every single time. If you have the right kind of mental attitude to approach the game, that's just God giving you a glimpse of what you could become, which is pretty cool, and you shouldn't be suffering from imposter syndrome, after 2 or 3 big wins in investing, thinking you just got lucky. No, that's your potential, and there's no reason you can't keep that string going. Same thing in golf, same thing with investing. So confidence is very important, I think.
And one thing that struck me was, you talked about what Rotella writes about lack of concentration and that you can lose a lot of shots due to that. But he also mentioned that the most important thing in golf is actually the short game. So what you do with your putter and wedges. And I just felt that many amateurs, including me, focused mostly on the long game because I think that was the most fun piece of golf. I just wonder, do you think there is an equivalent to a short game in investing?
Yes. And I think, so there's another book that I read, and I'll mention it. It's called The Elements of Scoring by Raymond Floyd. And I also read that one recently. And they hit on a lot of common characteristics between Golf Is Not a Game of Perfect and Raymond Floyd's book. And Raymond Floyd's more direct about it, but he said the reason why a lot of golfers don't score better is because they don't know how to play the game. And they don't know what's important to the game. The short game, chipping, pitching, putting is 70% of the game. But how often are you practicing pitching, chipping, putting? Raymond Floyd talks about the number one piece of advice he would have is, if you want to be a great golfer, practice 6-foot putts. Just get really, really good at 6-foot putts. What you're trying to get at too, Niklas, was just, I think the 6-foot putts, that equivalent is kind of knowing fundamentals, knowing financials, in the investing world. That sort of is your bedrock. You need to be able to know how to read a financial statement. And that's boring. And I think you can also take it a step further, just learning accounting, learning industries, learning how different types of businesses make money, learning how to value a business. If you're more of a qualitative investor, talking to management, talking to competitors, talking to ex-employees. These aren't sexy things. In fact, some of them are uncomfortable, but do you want to get better or don't you want to get better? Do you want to be a better investor, a great investor, or don't you? If you don't, then you're not going to put in the time and you're going to find an excuse not to do these things. If you do, you will find the time to do these things. So I think that those fundamentals of investing, learning the language of investing, which is accounting, that bedrock, and learning industries, learning businesses, learning how to spot good leaders, great leaders, trying to formulate the rough edges of a framework for pattern recognition. That looks like hard work, and it is.
So I'm curious to know now, how many hours do you put into that hard work? And do you have a way to measure how you improve as an investor?
I think the way to measure is always difficult. I mean, I've always just kind of kept journals for my watch list of companies. And, I think it's up of like 600 pages now in like a Word document. But there's actually better tools now. And you can create Excel spreadsheets, that immediately input, the stock price valuation. So you can order rank, the ones that your watch list that you have now. It makes it easier. But I really like, you had Jake Taylor on. I really like Journalytic. I've been using that for several months. And I think that's a great tool to be able to kind of look back at past decisions, even emotionally, how you made decisions. And I know they're going to make that product better and better. But I think there's different tools like Journalytic and some other things that are going to make it easier for you to get better. The hard part about and I think Jake probably mentioned it on your podcast with him, the hard part about investing, a lot of people like to look at, how do you get better with investing? It's like deliberate practice, and so everybody wants to talk about deliberate practice, and it's really just the golfers use this, everybody uses like kind of these methods of deliberate practice, like the 10,000 hour rule, these types of things. The problem with comparing that to investing and practicing that way is like just the feedback loops are so much longer in investing. You might not know if you're wrong for 10 years, where if you hit a bad shot in golf, immediately, and you change, you adapt, and you hit another shot. Okay, well, now it works. Well, it took 1 minute. With investing, you might not know you're wrong for 3 months, 3 years, 30 years. So how do you just shorten those feedback loops to where it doesn't take you a lifetime to get a little bit better? And so that's the tough thing. Or same thing about playing a musical instrument. Where deliberate practice works. It's like you play a bad note, you can hear it. So investing's tough because of the feedback loops with it. So any types of tools that you can include in your arsenal that can look at your things that you own and why you're making those decisions, and looking at things that you maybe want to own and how you would order rank, and go looking back in time. One of the things that I think maybe hurt me potentially is because I've been so concentrated in so few positions for so long. You could make the argument that I would have learned quicker if I was more diversified, because if I was in 10 companies over 20 years, I would have been able to kind of learn more about more companies and also about myself and my strategy, because it's just over more companies. I don't believe that's true, but I think there could be a case for that. Like actually starting off diversified instead of concentrated, you'd actually learn more because you'd have more experiences quicker. But I also find that on the being concentrated kind of has allowed me to kind of learn the emotional lessons of investing quicker. The highs are higher, the lows are lower.
I mean, talking about all these things that you think is, the most important thing to focus on as an investor to build that pattern recognition. I started to think about this when Rotella discussed those golfers that overanalyze the greens. And myself, as a golfer, I was quite annoyed actually when people took too much time on the green. How do you strike that balance between, actually knowing that, okay, now you know as much I need to make this investment? How do you get to that okay, these three things or something is the most important things for this type of business, and let me focus on that?
My answer to that would be different today than it was probably 10 years ago. I think today when I look at ideas, I usually know within 30 minutes if it's something that's special. That's kind of what I'm looking for. I'm looking for things that are special to me, that I think, hit all the things that I'm looking for. And I usually know really quick. Very rarely have I made money on something that's taken me a long time to get to a buy decision. And so for me, it's just a couple decades of pattern recognition and just looking for certain qualities or uniquenesses that trigger something in me that say, okay, this is something that is really, really interesting. And that might only happen a couple times a year, but that's okay. It's like, you're going to look at 1,000 different companies, and, you can't, and you shouldn't invest in all of them. And investing is a game of subtraction, just taking that list and down to a select few that you feel that are meant for you. And you have to be okay with the fact that, just like Howard Marks says, you're going to pass on a lot of ideas other people make money on. And you have to be okay with that. Those ideas are meant for them. They're not meant for you. There's a lot of even white papers showing that, founder ownership, large insider ownership actually doesn't mean anything more to your returns. It doesn't mean that they work out any more or less than a CEO that owns 1% of the company. And that might be true. That might not be true. But I know for me and how I invest, whether for me, I can invest longer in an idea and really believe in an idea when I know that the founder or the CEO or the management team has skin in the game, when I know they have to live with the consequences of their decisions. It just helps me be a better investor, investing in situations that have those qualities.
After you have found that business that you after 30 minutes think, this may be a home run. I mean, how long time does it usually take for you to digest that and think it over and so on before you actually make the decision?
It can vary. We've bought things in a day or two, and other things that might take longer. But it normally happens pretty quick, what I've found, which kind of goes against the grain of what we're taught or what we see other people doing, and I think, again, it depends if you're like, I'm a micro-cap investor, right? If I was investing in large caps or mid caps, it might be different, where I think a lot of investors, and maybe rightly so, they put a lot of front end work in and they try to be right from the beginning. It's like they're trying to find this thing that can compound for 25 years and they're going to be right from the beginning. And you can tell just through their process that, when you ever hear anybody saying, well, we put 6 months into the research process and we, do 85 expert calls and this or that and the other thing, to get to a buy decision, they're trying to be perfect, and I think you could.
But is that equivalent to what Rotella speaks about, that as a golfer, you shouldn't focus on the mechanicals on the golf course. You should focus that afterwards on the practice. I mean, is that similar, you think? I
think it could be. I think we all, it's hard to make comparisons to how other people invest, especially if they invest in large caps versus how I invest. And so I watch what I say. Relating to microcaps and on perfect, as investors, especially me, I know I'm not going to be perfect. So I feel like that frees me up quite honestly. Like I know going into it, look at my portfolio today of 6 companies, there's losers sitting there. And every day my goal is to find out which one of those losers is in my portfolio as much as it is to find the next winner. And I know that. And I feel like me knowing that I'm not going to be perfect gives me an edge to some extent. Because I think, especially in microcap and small cap, I think a lot of investors' returns, quite honestly, would probably be better if they allowed themselves to be wrong more often. They gave themselves up a little, just let themselves breathe a little bit, their philosophy a little bit. I think, taking perfection down to the stock level, when you're investing in microcaps, none of these situations are perfect. They're all imperfect. They all have hair on them. They all have something that's usually wrong. If they were perfect, they'd be perfectly priced. I think, as we know with studying multi-baggers or 100-baggers, it's just like, half the return is the growth and half the return is multiple expansion. It's like you're trying to find these imperfect things that could become something that's perfect later on. And so knowing that, I feel like when I look, I think of like when I look over the last 20 years in my framework today, I think if a novice came in and was trying to pick microcap stocks, they would probably have a 10% batting average. I feel like I'm 50 or 60, just after 20 years of experience of doing this. I mean, I'm still going to be wrong 40%. It's about controlling those losses and not having big losses and that type of thing. But I feel like the talking about perfection as it relates to microcap versus large cap is an interesting nuance in itself.
And I agree that it's good to be aware that you are not the best investor that you could be, and that's something that you wrote in an article quite recently on MicroCapClub, that inside every investor there is a better investor, and I think that's quite interesting, and it also relates to what Rotella actually finishes the book with, that we have to understand that even at our best, we will not come close to mastering the game, and in the end, you will realize that you love golf because of what it teaches you about yourself. I really think that is at the core of what investing is about as well. Or do you agree with that?
Yeah, no, I agree 100%. You learn so much. I feel like the market and your portfolio is almost like you sitting down on a psychiatrist's couch, asking them to internalize everything. The market will tell you more about yourself and your emotions than any psychiatrist can. I feel like that's, you'll learn a lot about yourself over the course of 5, 10, 20 years, because you're in your own echo chamber. It's the same as golf. The opponent there's other individual sports, but golf is like your opponent isn't the other players, even in tournament golf. It's yourself. And then a secondary opponent is the course. So golfers are in that same echo chamber, as investors are. Investing is an individual sport. You might have a team around you, but it's an individual sport. And so I think those are interesting similarities. And it's also what makes it so fun. I mean, I think one of my favorite lines, another lesson from the book too, is just, everybody invests differently. There's this quote that he talks about, like how the best players, whether it was Tom Watson, Bobby Jones, Jack Nicklaus, Lee Trevino, Gary Player, they took pride in the fact that their golf swings were unique to them. And to a similar, and the similarity there is, we all invest differently. And, the older you get, the more comfortable you become with who you are, unless you care about convincing other people they should swing like you. Your swing, your investing strategy is unique to you. And it's in that uniqueness is your edge. And, great golfers, have the conviction to make their swings their own, and I think investors the same way. The swing to a golfer is their art form, and their score is what made it beautiful. You can have a crazy swing like Jim Furyk, it's all over the place, and still shoot 500 par. You can have a beautiful swing like Rory McIlroy, have the same result. It's the same thing with investing. The way you invest, your strategy is your art form. Your long-term CAGR is the common ground that you'll be judged upon that decides whether that art form is beautiful or whether it's ugly.
Totally agree. But the challenge as a fairly young investor, having been in the game for 15 years or so, I mean, there's so much to learn, and that's what we're doing in the podcast and all the time around it. But we also need to take some time away from investing. So how are you dealing with that? That's something that Rotella is also speaking about. Don't just be on the golf course all the time and read a book and do something else.
Yeah, I know for me, and it might be just individual, but MicroCapClub for me has always been what I would call a productive distraction. Just running that community. It keeps me sort of a foot in the game. It's still centered sort of in investing. Obviously, it's microcap, but it kind of distracts me in all the right ways. Being a concentrated investor, kind of like what Rotella was saying too, is like, especially the more concentrated you get, the higher the risk that you overthink your positions. That you start looking at every little nuance as a reason to buy or sell. You feel every up and down of every movement when you're in 4 stocks because you see the impact in your portfolio. And I think it's important, especially if you're a concentrated stock picker, to have a productive distraction that will distract you from overthinking things too much. Because even the big winners that I've had over the years, none of them were perfect. Even as they went up 10 or 20x, they still had a quarter or two where they stumbled. And when you're concentrated in things and you're watching them, and you need something to work, or you're worried about losing money, you can't hold these stocks like you're strangling them. You have to hold them like a tube of toothpaste. You have to give them enough opportunity to disappoint you for a quarter or so. You have to give them that wiggle room. And you also have to give them enough room to exceed your expectations. And so I think it's important to have some sort of distraction. So for me, maybe it's not a good distraction because it still kind of keeps me in tune with the markets, but I think that's why I call it productive. MicroCapClub is a productive distraction for me that kind of takes me away from overthinking the 4 or 5 stocks or 6 stocks that I own. But obviously my family does a pretty good job of that as well. Just trying to be a good father, a good husband, good friend. I think a combination of all those things, as Niklas knows, he plays one round of golf per year anymore now that he has a family. It's because he focused more on the family as he should. Life's all about becoming less selfish, as you have a family and everything like that. You have to figure out how to get blood out of the rock, or how to, get what you want to accomplish in less time. I remember being able to sleep until 8 a.m. Only now, looking back 20 years, do I realize how much time I had. Now it's getting my kids up and out and off to school, right? So,
I mean, on the topic of aging, I think Rotella brings up a great example of the Red Queen effect, where a golfer always must work hard on maintaining the confidence. And Rotella also brings up that it's not about only that golfers that age becomes, they can't hit the ball as far as they can and so on. It's also that they change mentally, and that fear from having made so many mistakes, because as we said, no one is perfect, and the best golfers have made, many mistakes over their careers. How do you think that connects with investors? Do investors age well, so to speak?
I hope so, but I think the similarity there is, I think in golf, because it's similar to investing, you're in your own echo chamber. There's so much good times and so many bad times. Like the peaks and troughs to a professional golfer is probably insane, because it's all lived out in their head, whether they're playing a good shot, bad shot, when they have a 6-foot putt, not really thinking about making or not making it. They're worried about what people will think of them if they make it or don't make it, and that's a lot to do with investing as well. And I think the way you play, and so really it's back to investing. So I think it's similar to stock picking, especially in microcap and emerging companies, because, if you stay in microcap and small cap, especially if you're concentrated, your spectrum of outcomes is pretty wide. It's like you're beat up like constantly, because, you can make a lot of money and you can lose a lot of money. And I think those types of ups and downs over years or decades does create a decent amount of scar tissue. And the scar tissue, usually shows up with an investor it usually comes in more and more as a fear of failure that ultimately derides their returns. They're afraid to take risk anymore because of kind of just dwelling on the losses they took prior. Or maybe they look back at some of their wins and it's a little bit of wow, I really got lucky there. That wasn't skill. That starts creeping in a little bit more and just kind of deadens you, creates more scar tissue. And I think that's generally why you also see just investors get more risk averse as they age. Like the only person I think that is the opposite of that is Bill Miller, the great investor. Like there's very few people that are in their 80s, slinging 3 stock Bitcoin portfolios. That risk was beaten out of them 20 years ago. And so that I think that he's one of those rare instances where, he's not afraid to swing, and oftentimes that if you stay in this game long enough, I think you just get afraid to swing, and it just destroys your returns, quite honestly. And we all know that our worst rounds are played when we approach the game that way. And our best rounds are when we look at the target and we swing. So getting back to your point, Buffett's been doing this for a long time, 40 or 50 years. He's not doing small and microcaps, like his spectrum of outcomes is like right here. It's pinched, and so I think that's why folks that kind of stay the duration for 40 or 50 or 60 years, obviously their net worth and their portfolio size has given them the ability to probably take less risk as well. The way they got rich is sometimes differently than how they got really, really rich.
How do you think about Munger's idea of having low expectations? To not create that huge emotional effect when something goes against you, that you're prepared for it. Because it goes against what we spoke about before about, having strong confidence and so on, I think. That's the... Yeah,
I really believe in confidence and conviction. I'm a conviction investor. I wrote an article about it last week, and I feel like, for me, every one of my investments, I think I'm right. I know I'm right. And I say that tongue in cheek because I know I'm going to be wrong on a few of them. And I think you do need to, I do feel like you really do need self-confidence in this game, even when you maybe don't deserve it. And I think the best educator is investing. Like that's my best advice to anybody that's new in investing would be the same advice to anybody picking up a golf club for the first time. Just go swing, figure out who you are, figure out what you want to be, in investing, figure out how you want to swing. Just go out and hit a ball. Don't be afraid to lose money if you're going out to invest, because that's how you're going to learn the hard lessons. And you can't learn those lessons in a book or learning about how other people did it, especially if you're a type A person that thinks they already know everything, which a lot of us thought we did when we first got started investing. Move over, Buffett. I'm coming for you. So you're just going to have to learn these lessons over time.
I think we have covered this topic a bit, especially in the beginning where you spoke about your teacher who played with one arm. But I really loved it so much, so I have to bring it up, and I think we have we will have some good discussions after it. And the quote was, "Many a player has been cruising along in a match until his opponent suddenly and unexpectedly sinks a long chip or comes out of the woods to make par. Surprised, he loses his focus, starts to feel pressured, and fouls up his own game." And I really think this is striking for the time we have been through with after the COVID effects. How is it for you? I mean, you have been investing through bear markets and bull markets, and do you care about the market when you invest?
The way I care about the macro is to care about the micro. And, that's definitely something that's evolved over time, and so do I follow the macro? Yes, of course I do. I'm not an idiot, but do I worry about it? No. What I try to do is plan. And so the way I plan is by looking for certain set of principles and characteristics in the companies I invest in, that if the worst case scenario happens, I know that they can survive and still grow. And so the way I handle the macro, the market pressures, is really to be focused on my individual investments. Can these businesses grow through a recession? That takes the opportunity set down to 3 or 4% of companies. Do they have a balance sheet, especially when you're talking about microcap? Do they have a balance sheet that can endure through a bad period of time, where they can be aggressive when their competitors aren't? Are they led by intelligent fanatics that have skin in the game with that business? Do they have great people around them? Do they have the product, processes, culture that can scale? And lastly, the valuation, comes back to valuation. Price does matter. It's do I think that fundamentally this stock can double in 3 years, or 25% CAGR? And so when you put things kind of through a framework, that's just mine, it shouldn't be yours or anybody else's, but when you put things through that, do I worry about macro? No, you just plan. You just plan for the worst. And I think the best companies do have a duality of growth and survival to them, and that's predominantly what I'm looking for, things that can sustain high organic growth rates that can survive, and also one businesses, not one of 1,000. Is this, I love the idea of scarcity. It's something that I've always liked it, for the last 15 years. I've only been able to kind of write about it in the last 5, but just finding those one businesses where we all want to find something overvalued that can get undervalued, that can get overvalued, and scarce, good or great businesses always get overvalued because there's a scarcity of them. And so when you can find a business where it's really the only way to play in a certain trend or area, that's a powerful thing. That's like finding a Picasso.
We covered a lot of the process of investing, but then the results are also important, of course, and we touched upon it. But something that Rotella believes that golfers should not use is a scorecard outside of tournaments, and that is because they get distracted from playing and making the next shot. And I think this is similar to investors checking stock prices all the time and being obsessed with the market. So have you found any way to get your dopamine boosts without checking stock prices?
No. I check stock prices frequently. I think where I would invert that a little bit. So I'm not one that says you shouldn't watch your stock prices or only should check it, every third Thursday or, whatever. And it's probably because it's just the way I've always been. I have no issues with checking stock prices. I think the issue, and and you hit on this as well, Eddie, is just looking at the scoreboard, looking at other people's scoreboard and comparing yourself to other people. That's something that I think is really, really toxic. And like you said, Rotella said, one of the most common mental errors committed by golfers under pressure is letting the score distract them from what they ought to be thinking. I think investors do the same thing as well. I mean, we always see at the end of a quarter, it's like we all love to act like we love reading everybody's quarterly letters, right? But what's the first thing you do? You're going to go to the performance line and you're going to compare what you just did that previous quarter, that past year, and compare yourself to it and feel good or bad. And everybody, and it's the stupidity of it is that we all invest differently. Everyone will perform differently over different time periods. And it's the most toxic thing you can do is because the worst part of it is when you're doing poorly and you're doing that, you're comparing the worst of who you are against the best of everybody else. And it just puts more and more, pressure on yourself. And it can lead you to doing stupid things like changing your strategy in unnecessary ways or taking on more risk. And you just can't let that short-term underperformance, whatever, distract you from the long-term game you're playing. So, I try not to watch the scoreboard, obviously I still read people's investors' letters, and I don't mean to say that's an awful thing, but I don't like the comparison part of investing. I feel like that is really, really the worst part and the most toxic part of investing because you're comparing a game you're playing against somebody else's completely different game.
I love the example from the book where I think it was Jack Nicklaus who was at the 16th tee in a tournament in the fourth round, and he hadn't looked at how the other players were playing, and then he asked his caddy, okay, how do we stand? And the caddy says, oh, you're 7 up. And then he hit a double bogey immediately after. So it's, maybe that was just a coincidence, but I think it was quite interesting.
Yeah, no, exactly. You want to play each hole that you're confident. That means hitting shots that you can hit. It means playing high percentage shots that you can hit. That's what gives you confidence. And we kind of already hit on that too. But I think, oftentimes as investors, after you do have a bad shot or a bad investment, the risk is just making a really bad next decision. When I had a couple big wins when I was a full-time private investor and a couple big losses, I told my wife then, I said, it's time to go on a vacation, just like clear the head. It's a lot less expensive to go on an expensive vacation than it is for me to make a dumb decision after a big win when you're feeling overconfident or after a big loss where you're just second guessing everything that you're doing. You don't make good decisions when you're really, really overly confident because you feel like you have all the answers. When you're doing really, really poorly, you don't believe in anything. You don't believe in yourself. You don't believe you can make any type of good decision, and you don't want to be making decisions when you're above or over that band. You kind of want to stay right in the center.
And how does that work for you now that you are the CIO of Intelligent Fanatics Capital Management? Do you have some colleagues to discuss with, or how's your team set up?
Yeah, so I have Michael Liu. He works with me full time as an analyst, and MicroCapClub's always been that for me as well. It's like that's just been a huge place, a huge resource for me to network with investors and build relationships with other investors. That's what it continues to be for me. I mean, it's a great idea generator, but kind of in the catbird seat of that website has also allowed me to kind of spot up and coming talent in the microcap ecosystem. And so that's where I got to know Michael Liu when he was 15, when he became a member of MicroCapClub. Now he's 22, he's still young, and he'll be smarter than I ever will be. And that's what gives me gratification is just, trying to lean into some up and coming talent, because, hey, listen, Buffett, Lynch, Greenblatt, they all started in microcaps. So it's not too far-fetched to think the next great investor may come out of microcap, and so they just happen to grow up and out as their capital grows over time. All those investors did, and so I think microcap is a great place to spot talent for investing. It's a great place to learn because you have to form independent research and independent thoughts because there's no analyst covering half of these companies or more. So you have to do the work. There's no one else to blame but you. So I think it's a great place to start investing because you have to do the work.
And what are your ambitions with the firm long term?
I would hope in 3 to 5 years that a couple of the microcaps we own become small caps. They're going to be big chunks of the portfolio. Do I think that I'll be running 2, 3, 5, 10x this amount at some point in time? Yes. How do you get there? It's not going to be from bringing on another $200 million. It's going to be from those stocks going up. And so the way this portfolio evolves over time is, it's going to look a lot like a sports team, where you're going to have some veterans on that team. They're going to deserve a bigger position and a bigger salary, and then you're going to have rookies. You're going to be constantly trying to scout talent, and you bring them on at a smaller position size. And as they grow, they might become the next veterans, as they earn that right. And then there's going to be some you bring on the team that disappoint you. You end up cutting them. Then you replace them with another rookie. Hopefully you can find the next set of veterans. So that's kind of the way I see the portfolio evolving over time. And you can't pressure it. There's nothing I can do to say, all right, well, let's do this. It'll evolve naturally.
And do you have any limitations around countries or sectors to invest in?
No, I don't. Like we have, we're concentrated, but probably half the book is in the US. We had a couple in Australia. We had a couple in Europe. We did have a couple even last year in the Nordics that we looked at, that we put on quickly and took back off. So we can go anywhere. I would say it's predominantly English speaking, similar accounting rules, developed countries for the most part.
How do you think about portfolio concentration? I mean, you mentioned 6 stocks, but could one stock become more than 50% of the portfolio, or how do you think about that?
If we are successful, yes, that is a positive outcome. In that scenario, you have one foot in reality, and you're always comparing it to the reality of that business. That's why maintenance due diligence is the most important part of any conviction investor, is knowing what you own at all times. And not just because it's 50% doesn't mean it should remain 50%. Is the state of the business today somewhere where I think that this business can still double in 3 years? Doesn't mean you never take it off either. The formula that's worked for me is whenever a stock gets to the price where it's kind of bringing forward the next 3 to 5 years of fundamentals, that's usually when I start taking some off. Other than that, I let them run and let them run hard. So yes, I would let a position get to 50%. You just have to watch them closely, watch that basket.
I think Richard Lawrence that we had on the podcast had this concept of getting tomorrow's price today, and then you should sell more or less.
Yeah. Well, I mean, a couple of our larger positions, that's literally what the CEOs, and because I have good relationships with them, I mean, that's what they think about their businesses too. Like literally, that's what one of them told me. Because I said, if somebody offered you a price, what would the price be? And he said, well, if they gave me a price that I felt I was getting where the business would be in 4 years, that's something I would have to consider, And so I think the more you can kind of align yourself to what management believes, in that regard, again, keeping 2 feet firmly in reality, as long as that business is executing. If the business is not executing, you should sell it. It doesn't matter if you like the CEO and they own 20% of the company and they allocate capital greatly. If the business isn't executing, you sell it. So that's first and foremost. But if the business is continuing to do what they should be doing, let your winners run. That's what I firmly believe.
And have you invested like most of your own money in the stock, or how does that work? Yeah. So a majority of my net worth is in the fund now. And is it open for any of our listeners if they are interested in joining?
It changes. Right now we are open, bringing on a couple new partners this month. But we've been closed quite a bit. Usually when I think that it's an opportunistic time to come in at the prices of the companies that we own is when I would open up, which, is usually when we're down a little bit more than I think we should be. And we're getting good value in what we own. That's when I open up and then close it back up again.
And do you have like a waiting list for that? Or?
Yeah, we have a waiting list of folks that have shown interest. Doesn't mean that they decide to to come in, because quite honestly, usually when you're in a drawdown, either your own portfolio or the macro is right when nobody wants to write a check too. So, you're kind of going up against that headwind of sentiment, which everybody goes through. It doesn't matter whether you allocate $1 billion or 100,000, everybody fights that.
Understand. And as this is a book podcast, we like to wrap up with some questions about reading and writing. And the reason, I've read your books before and I've listened to podcasts with you, but why I found this book to be interesting was because you mentioned it in Vishal Khandelwal's, one of our previous guests, his own podcast, The 1% Show. And there you had a couple of books that you recommended, but maybe you have some other titles that you could mention for our listeners that you think is relevant for investors and that maybe not that many people have read.
I mentioned The Elements of Scoring. If there's golfers and investors, I think that's another book that is applicable to investing. I've been going through a phase where I've just been reading a few novels, quite honestly, to kind of get the creative outlet going. And that's why I like to read novels. It's not just all about educating myself. If you want to, I like to let my imagination go, because that's usually what spurs creative thought for writing, for journaling. And I find that just as additive as reading things that are directly related to investing.
And how much are you reading in a typical week?
Usually my process is getting up at 5 a.m. and that first hour of the day, I'll grab some coffee, and the first hour is just sitting down with the book.
We really appreciate you taking the time and sharing your thoughts about golf and how it can make us better investors. So do you have something more you want to add before we finish up here?
No, I think we covered a lot of bases. I really enjoyed it. I appreciated the thoughtful conversation.
And lastly, where can our audience follow you and the work?
You can follow me on Twitter. My handle is just my name, Ian Cassel. You can find me on MicroCapClub, talking about stocks, networking with people. And we also have a fund, Intelligent Fanatics Capital Management. We have a website there. If you Google it, that you can find me there as well.
Thank you so much, Ian. This was great.
Thank you.
Thank you so much. Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.